Hello, hello. Everyone hear me? Okay.
Let's wait for a few minutes before we start.
Let's wait for a few minutes before we start. Hi everyone, thanks for joining us today. Thanks for coming down. I know it's 3 p.m. It's during working hours. Yeah.
Let's go.
Okay. Okay. Good afternoon, everyone. Welcome. Thanks for coming down. Today will be our first session for our webinar series. Today we have a special guest. It's Hazelle from the Joyful Investors.
Hey, thanks, Elwin. Good afternoon to all of you. First and foremost, thank you, ShareInvestor, for inviting me this afternoon to do the sharing with the community. So it's great to see all of you guys here in this webinar at 3 p.m. in the afternoon. So in this session, I will be sharing with you on how you can navigate the US inflationary landscape, as well as the recent market downturn in Singapore REITs as an investor. Okay, but before I get started, allow me to do a very quick introduction of myself. I'm Hazelle, the Chief Trainer and Co-founder of the Joyful Investors. And what we do at the Joyful Investors is that we focus on sharing valuable content that empowers individuals who are on their journey towards achieving financial independence. Right, so you can actually find us on our YouTube channel, where you will see videos that are covering various investing concepts, as well as the essentials of investing, right? We also do post blog posts and articles as well on our website, where we'll cover from the basics of investment knowledge to sharing with you our views on how to navigate the market for the more seasoned investors. Right, and if you want to stay updated with our latest insights on the latest market happenings, you can also follow us on Telegram. Okay, we have a public Telegram channel as well as our Facebook page. Then for more bite-sized investing tips to smoothen your learning curve, you can actually find us on Instagram. So the social media handle is the Joyful Investors. Okay, over here. Okay, a quick disclaimer before I begin. Anything that I share with you in this webinar, okay, it is not a financial advice, it is not a financial recommendation. So please do your own research and due diligence before you get started on any investment or trading decisions. So this webinar itself is more for educational purposes, where I share with you my personal opinion. Okay.
Yeah, all right, Hazelle, to get started, perhaps you can share with us what are the main areas that you will be touching on in this webinar?
Okay, sure. So this is the agenda and the overview of what I'll be sharing with you guys this afternoon. So firstly, I will kickstart with doing an update on the S&P 500 earnings season for the latest quarter Q3 2023. And the reason why we look at earnings results is because they tell us more of the fundamentals, okay, for us to evaluate the overall fundamentals of the S&P 500 as a whole, to see how well the companies have been doing so far. Then after which, next we will then move on to take a look at the US inflation situation for the month of October 2023. Now, the November inflation data is not out yet. Okay, it will be out, in fact, tonight, okay, at 9:30 p.m. And finally, I will also touch on the Singapore REITs market downturn, right? And I'll share with you 3 very important timeless principles that we should keep in mind as we are investing in the Singapore REITs markets, as well as for those of you who are thinking of starting out, dipping your toes in the Singapore REITs market. So all this will be useful for you. Yeah.
Great. There's a lot of learning in this webinar. Let's kickstart with the first item on the list. How did the S&P 500 companies perform in the recent earnings season?
Okay. Yeah, so almost all of the S&P 500 companies, they have already reported their earnings for this third quarter of the year. Among those that have reported, the percentage of S&P 500 companies reporting an earnings surprise is 82%. Okay, meaning that the actual EPS that they report is above the estimate. Now, this performance is actually considered pretty encouraging because it is higher than the historical averages. So the 5-year average we have here is 77%, as well as the 10-year average is 74%. So the 82% is actually much higher as compared to both the 5-year and the 10-year historical average. And in fact, this is on par with the Q3 2021 performance. So this would actually mark the highest percentage of S&P 500 companies reporting a positive EPS surprise since 2 years ago. That was in 2021 already, right? Then in terms of the magnitude of the earnings surprise, the companies are actually reporting a 7.2% magnitude of earnings surprise, okay, above the estimate. So this 7.2%, yes, is below the 5-year average of 8.5%, but it is still above the 10-year average of 6.6%. So I think it's actually pretty not bad already. Yeah. And in terms of the year-on-year, the blended year-on-year earnings growth rate, it is currently at about 4.8%. Now you might be thinking, okay, 4.8%, is this considered good or bad? This is actually much better than what the analysts had initially estimated. So before the onset of the earnings season, okay, what the analysts have estimated was actually a negative 0.3%, right? A negative percentage. But right now, what we're having is actually a positive 4.8%. So it's actually much better than the initial estimate by the analysts. And in fact, this would actually mark the first quarter of positive EPS growth since Q3 2022. And that was already about 1 year ago already. Yeah. Yeah, so moving on, we should have already passed the earnings recession for the S&P 500 already. All right. For the benefit of those who do not know what is an earnings recession, okay, this is the definition of an earnings recession. It is defined as the period where there is a decline in the year-on-year profits for at least 2 consecutive quarters. So if you look at the table over here on the left, you can see the area that I have boxed up. That is where we had the earnings recession, where the earnings had contracted starting from 2022 Q4 to 2023 Q2, right? And then the most recent quarter, Q3, that is where we have a positive earnings growth again. Okay, so that's why moving forward, it's forecasted that the S&P 500, it should continue on this positive earnings growth trajectory. And so overall, I would say that we have a rather positive set of earnings result for the recent quarter for S&P 500. And we are actually in a good recovery for the earnings, as well as the fundamentals of the overall S&P 500 companies. They're actually performing pretty well. Yeah.
Okay, moving on. Let's now switch gear to assessing the situation for the US inflation. How is the inflationary landscape now?
Okay, so for inflation, these are the inflation data for October 2023. So you can take a look on the left, you have headline inflation. For October, it is 3.2%, which is a decline from the 3.7% in the previous month. And then for the core inflation, right, it is 4%, which is also a decline from the previous month of 4.1%. Meaning to say both the headline and the core inflation, what we are seeing is actually a downward trajectory. So this indicates that we are having a rather positive progress. We are seeing a positive progress from the rate hikes that were implemented by the Fed, okay, since March 2022, which was when they started on this rate hikes. Yeah.
Quick question. What is the difference between headline inflation and core inflation?
Okay, yes. So headline inflation itself is about the total inflation. So we take into account of the price changes for all the goods and services in the consumer bucket. Whereas on the other hand, the core inflation, we exclude the volatile items, which are food as well as energy, because these are the categories where they are more prone to short-term price fluctuations. So that is the difference between headline inflation and core inflation. In fact, a very common question that many people, many investors, they ponder about is this: between headline inflation and core inflation, which is the one that the Fed focuses more on generally? Now, the answer is actually core inflation rate. Generally, the Fed focuses more on the core inflation rate. So this is not by me, but this is direct from the horse's mouth, right? You can see over here, there's a screenshot over here. I took this from the Federal Reserve website. So under the area which is being boxed up, okay, I know the fonts are a little bit small, but what it says is that the Fed generally they examine a variety of core inflation measures to help them identify the inflation trend. And when we are looking at more volatile items, in one period, if we have a large price change for the volatile items, it does not mean to say that the next period, it will also be followed by a similar large change for the following period for volatile items. So that is why, even though food and energy, they do make up an important part for household expenditures for consumers, but generally for the Fed, when they want to assess the overall inflation trends, looking at core inflation would be something that is more useful for them to assess. Yeah. So in fact, if I could switch back to the previous slide, if you look over here, let me try and draw it out. Okay, if you look over here, this region, right, which is from July to August, September, the headline inflation actually increased slightly, and it was quite sticky at around 3.7%. So at the time, some people were actually worried, right? But we also I was sharing with my community back then that although the headline inflation seems to be going up slightly, but for core inflation wise, look at the same period, they are actually still coming down. So which is a positive aspect to tell us that the inflation is still in a downward trajectory as of now, right? Let me clear the drawings first. Okay, yeah.
It's good to see inflation is on the downtrend now. Could you also share more on your views on the upcoming rate hikes?
Yes. So when we talk about inflation, the next thing that will come to investors' mind will be in terms of the rate hikes, right? So how is it going to be like? So right now, the current rate, the current Fed funds rate is at 5.25% to 5.5%. And I'm actually more of the view that we are already at, or at least near the end of the rate hike cycle. So there is this tool which we can actually use to help us give us a rough idea of how the upcoming rates would be like, right, in the upcoming FOMC meeting. And this tool is what we call the CME Fat Watch tool, right? So this is actually available for free, right? Just do a quick Google search. You can find it on the CME group website. So what it does is that it tells us, it analyzes the probability of rate hikes or rate cuts, okay, the rate moves for the upcoming FOMC meetings. But do take note that when you're using this tool, right, whatever percentage that you see, it's going to fluctuate. So today, if I see 90%, tomorrow it might not be 90%. Because why it will fluctuate is because it will change based on changes in the economic data, changes in the geopolitical events, or any other factors that can influence the market sentiment. Okay, so maybe let me just do a very quick demo to show you guys how it looks like. Okay, so let me switch the screen. Share the. Okay, so can you guys all see the new screen, right? Okay, so here, this is the website, okay, the CME Fat Watch tool. So if you scroll down, you will see over here, this is now showing 13 December, meaning to say for the next FOMC meeting on 13 December, okay, the current target rate is this 5.25 to 5.5%. And then the probability that it will still stay constant at 5.25 to 5.5% is about 98%. Okay, then this 1.6% is the probability of a rate hike. Okay, 25 basis rate hike. So of course, you can also click on other dates. For instance, if I click on the second next one, right, which is 31st January, you can see, okay, so it is likely 94% chance that the rate will still stay at 5.25 to 5.5%, all right? Then 4.1% of a rate cut, and then 1.6% of a rate hike. Okay, let's also take a look at one more. Okay, let's say we look at March itself. Okay, so March, you can see that we have more variation. So right now the rate is 5.25 to 5.5. So the probability of it staying constant is about 50%. Then the probability of a 25 basis rate cut, because this is 5 to 5.25, right, it's a 47%. Okay, so but like I said, the percentage will change. So right now you see this percentage, but 1 month later it might change. And of course, the further away the meetings are, the more volatile it will be, because there could be more changes in between based on the economic data or any other events that's happening. Right, so this is the tool that you can actually check out for yourself because it's available for free. Okay, let me just do a switch back to the slides. Okay. Okay, we are back on the slides.
Okay, thanks for sharing on the US stock market outlook. Let's move on to the Singapore REITs market downturn. How should investors navigate the Singapore REITs market crash?
Okay, yeah. So right now the Singapore REITs market continue to be beaten down and it's still underwater. Recently, there are also a lot of discussions about whether an investor should actually be investing in the Singapore REITs market. So some people, they are of the view that okay, we should stay away because of this high interest rate environment, right? Even though right now the Fed has it has not raised the rates further, but then the interest rate is still very high. So there are some people who think that okay, the sell-off for the Singapore REITs market is not done yet. On the contrary, there's another camp of investors who will think that okay, right now actually this is a very good opportunity to accumulate some positions of the Singapore REITs at cheaper prices. So with these differing views, I can understand that it can be quite confusing for investors who are trying to navigate the market. So if we take a look at this stock chart over here, this is the stock chart for the Lion Philips SG EPF. Okay, the ticker symbol is CLR, right? What we can see is that from the peak in 2021, it has actually declined by more than 20%, right? In fact, just a couple of months ago in October, right, that was where we actually revisited the COVID lows. Okay, so this is the COVID crash over here. And then this is a few months ago in October, where we actually hit the lows that we last saw during the COVID crash itself. So it can be actually quite daunting and scary for investors because they are not quite sure how to navigate this situation. So I've actually compiled these 3 investing principles, okay, or 3 pointers that can help you to navigate the Singapore REITs downturn that I think investors, they should keep in mind when they are investing in the Singapore REITs market. So the first is, please bear in mind that the macroeconomy is always dynamic, it's always changing. So do not be overly fixated on what is happening in the economy, but rather my preference is I prefer to focus more on the fundamentals of the Singapore REITs itself, of the businesses that I want to invest in. Because just take a look at what has happened over the past 2 to 3 years. Let's do a very quick recap. In 2020, that was the year where we had COVID outbreak, and we actually went through the lockdown. Okay, but shortly after, in 2021, thankfully, vaccinations, they were invented. Okay, and then the whole world, different parts of the people from different parts of the world, we actually embarked on the vaccination program. And that's how eventually, in 2022, we had the border reopening, right, including Singapore as well. So people were able to resume their travel, whether is it for business travel or for leisure travel. So, but unfortunately, what happened? Okay, things did not just stop there, right? Things did not move smoothly. We had the supply chain disruption, okay, which led on to the inflation. And then, unfortunately, we also had the geopolitical event, which is the Russia-Ukraine war, which drove up the oil prices, and it further accelerated the inflation situation that we had. And that is where it led to the rate hikes by the Fed in March 2022. So the key lesson over here for us to learn is that the list of macroeconomic worries, it never ends, right? So there are some investors who would prefer to wait until there is no crisis before they are before they feel it is safe to begin investing. But more often, what happens is that they will find themselves always staying out of the markets and missing out on the market recovery. Because just take a look at the news media, you will see macroeconomic worries, right? Every other day, every other month, or every other week. That's why instead of focusing on all this macro outlook, I prefer to actually focus more on the fundamentals of the Singapore REITs itself to decide if I want to invest in, instead of being overly fixated on the high interest rate environment that we are having right now. So the way that I see it is that the supposed crisis can be seen as an opportunity where I can buy or I can accumulate positions of some of the good Singapore REITs at cheaper prices during the crash. But of course, having said that, for us to be able to do so in the first place, we need to have the conviction in what you're investing in. If not, you will have weak hands and you may end up selling during the crash, right? So this brings me to my second point, which is that always remember, even though we say, a particular REIT is fundamentally sound, but they would still be affected financially during the challenging periods. Okay, it is not to say that a REIT is fundamentally sound, then its financial wouldn't be impacted. For instance, if you look at the this screenshot over here on the left, you can see this is the financials for Keppel DC REIT. Now, this is their financial performance in Q3 of 2023. So you can take a look. The area that I boxed up, it shows that there is a decline in its quarterly distributable income, a decline of 6.5%. DPU, a decline of 3.6%. So even though if you take a closer look, the gross revenue has actually increased slightly. The property expenses have also improved slightly, leading to a slightly better net property income. So even though in terms of the operational wise, they are actually doing not bad, right? Still stable, even though currently the macro outlook is not as good. But because of the higher finance costs that have offset their stable performance, and it resulted in a lower DPU as well as distributable income. So the message that I want to drive across here is that always remember and keep in mind that even good businesses, they are not entirely shielded from the external environment, which may impact their financials in the short term, right? But do not panic, right? Do not be alarmed by this, because over the long term, the good companies, their sound fundamentals, as well as their accumulated financial resources, it will help the businesses to overcome the challenging periods. Okay, and that's why we should learn to focus more on the broader picture, right? Instead of panicking for the short-term macro outlook. Okay, I have an analogy for you over here. Okay, it's just like, sometimes you visit your favorite chicken rice store, right? Or it can be any other store in say a hawker center. And you find that there are times where your favorite chicken rice store, they may also underperform occasionally, right? When the owner is unwell. So the taste might not be as good as what you usually taste. But would you still continue to patronize the store? Now, I don't know about you, but for me, I will lah. Okay, because I know that overall, over the long term, most of the time, his chicken rice is still good. Okay, it's still delicious most of the time. And I understand that even the best chefs in the world, they will also have periods where they underperform. Okay, so similarly, when it comes to investing in Singapore REITs, right? There may be periods where even a fundamentally sound Singapore REIT, its financials can be impacted in the short term. Okay, but as long as the overall longer trend, right, longer term trend of the performance is still steady and strong, right, then that is fine. So this is the second pointer that I would like you guys to actually bear in mind. And thirdly, the third one is to always remember that today when you invest in the Singapore REIT, to calculate the total returns of your Singapore REIT investments, you have to take the sum of the dividends that you collect and the capital gain and losses on the underlying units of REITs that you hold. So the dividend yield alone, it is not our total return for Singapore REITs investments. Now, why I'm saying so is that very often when investors invest in Singapore REITs, they are largely fixated just on the dividend yield alone, and they will tend to chase after REITs that give them the highest dividend yield. But they forget that actually the capital gain and losses, they are also part of their total returns. Okay, because today Singapore REITs, right? You buy them, you invest in Singapore REITs. Their unit price moves just like any other stock in the stock market. Okay, they go through price fluctuation. It could be as big as 20% or even more. All right. Now, just to give you an example, it is the same as how the concept is very similar to how if today you own an investment property, right? If today you own an investment property, you buy it at $1 million. But right now, the market value dropped to 900K. So you have a property value decline of 100K. Then for the entire year, you have collected a 50K for rental. Now, my question to you is, are you generating profits from this investment property right now? The answer is actually no. Because why? The rental that you collect 50K, it is in fact not sufficient to cover the 100K value decline in property. So it is not really right for me to say that I have been making profits from this investment property. Even though the 100K, it is like a paper loss, all right? Because the moment I haven't sold the investment property, okay, it is not realized yet. But it is still part of my my profit and loss nonetheless, right? So likewise, in the case of Singapore REITs, the dividend is like this rental over here, okay? Then the capital gain and loss is this, like this property value decline over here. So the key takeaway is do not just simply chase after the Singapore REITs to give you the highest dividend yield. That is not enough, right? Because we don't want a situation where the dividends we are collecting is simply just being used to cover up the capital losses that we suffer on the underlying units that we own. In fact, there are many occasions, right, where we hear from some REIT investors where they say that after investing in Singapore REITs for some years, they find that actually they haven't been really making much money. Or, you know, the amount of dividends that they collected is just only being sufficient to cover the capital losses that they incur along the way. So this is a situation where we do not want to be in, right, as a Singapore REIT investor. Yeah. Okay, so
so what can investors do then to make sure they do not fall into such a situation?
Okay, so in other words, today for investors, what you can do is we have to learn to manage our investment risk. To manage our investment risk, there are two specific actions that we can take, and these are actually the actions that I personally myself will do. So firstly is, of course, always invest in the fundamentally sound Singapore REITs. It is not merely about buying the REIT that gives you the highest dividend yield. Because what a lot of investors are doing is they will just go to a screener and then they will just screen for the REIT that gives them the highest yield, and then they will just buy. Because today the dividend yield alone is not your entire return from this Singapore REIT investment. So in fact, if you invest in a REIT where the fundamentals are unsound, you may see that the share price performance may actually turn into a perpetual downtrend, which is something that we do not want, right? So how to identify the fundamentally sound REITs? That is where we have to perform fundamental analysis. We have to analyze the financial performance of the Singapore REITs to assess their fundamentals. Then the second action that I also take is to actually buy the REITs only at certain price levels where where I would say that the risk to reward is more in our favor. And the reason for doing so is because if you realize many of the Singapore REITs, they exhibit largely cyclical price movements, right? So what we don't want is that we want to avoid buying at the top of the cycle. So instead, what we can do is we can apply technical analysis where we try to identify certain support levels, right, or certain price levels to buy at, because the probability of a rebound from the support is generally higher. So the risk to reward is actually more in favor for you when you do so. There are some investors who will just randomly buy at any other price level, right? But after a few years of investing, then they realize, okay, the dividends that I'm collecting is just being used to offset the capital losses that they incur, right? Because of this cyclical price movement of the Singapore REITs market. So these are the two actions that myself personally I execute in the stock markets to invest in Singapore REITs. Yeah.
Thank you for sharing with us. We do have some questions.
Okay.
Maybe if from Lee Chengxiang, which sectors of the economy will stand to benefit significantly if the Fed cuts the rate hikes next year?
Okay. So in terms of the sectors of the economy, of course, for instance, right now, right, even right now, not we are still in 2023, you can already see that some sectors like the tech sectors, right, they are already benefiting, right, in terms of their share price movement. They have actually recovered and rebounded quite a lot. Okay, because when the interest rate, when the rate is high, then the valuation of all these growth stocks, right, they will be depressed. And that's why they actually crashed by a lot more back then in the 2022 market crash. So some of the sectors that may actually stand to benefit with, for instance, it could be the technology or even the consumer discretionary and so on. Now, but having said that, to me, these are just textbook answers. These are just textbook model answer as to which sector is likely to, do better when interest rate is down, when the Fed starts to cut the rates. And I don't actually just follow blindly. Instead, for me, what I do is I will still go back to the stock chart, right? And look at the various sectors, their performance. Like, for instance, right now, the tech sector has actually run up by a lot. And my personal investing style is I don't chase after the prices. So even though it has run up by a lot, but I'm not going to chase after the tech sector to buy more shares right now. Instead, I'll wait for a correction where it comes back down before I add shares. So at the end of the day, we can have the theoretically right answer as to which sectors are likely to perform. But what I would still do, and what I think that is more reliable, is to still fall back to the stock chart and look at how the various sectors are performing in real time in 2024. Yeah.
Thanks for sharing. We do have a few other questions.
There's one question that is on what is your view of CapitaLand and Mapletree Singapore REITs that has exposure to China and Hong Kong? So for this, firstly, you must understand that China, when you're investing in China, you can actually expect more volatility. Okay, and right now, what they are going through is they're actually resolving some of the issues that they have, like in terms of the over leverage for their properties. So any investment that has exposure to China, okay, in one way or another, so firstly, you must have the conviction, okay, so that you can continue to hold on to it. If not, when you go through the volatility, it might be very easy to actually let go of your investments where you just sell them because of the crashes. Okay, but overall, actually, we also Okay, this is not a financial advice, okay, but personally, I'm just sharing. We also do have exposure to China in terms of equities, right? As well as Singapore REITs as well.
Um, okay. Any other questions? Um,
Okay, there's one. The Singapore market seems to be lagging compared to the US market. Why is that so? Okay. In fact, if you notice, it's not just right now. Even if I could rewind back in time to say the previous crash, during the COVID crash, right? The recovery for the US market was also largely faster. Okay, if you look at let's say the SPY ETF, the S&P 500 as an overall benchmark for US, versus if let's say you look at the SCI, okay, as an overall benchmark for Singapore market. You can also see that the US market actually rebounded faster as compared to the Singapore market. But one reason in the current situation why that may be so is because for Singapore market, right, we also have a high concentration in some of these REITs as well, which are actually being beaten down. And that's why you will see that the overall SG market is also lagging, right? Then overall, for US stock market, in terms of the mix of companies that we have actually more of those faster growing companies as well as compared to Singapore. The makeup of the industries, right? They are more, I would say, an older economy, where you have more, we have less of those growth companies or even tech companies and so on.
Okay. Thank you, Hazel, for sharing with us all these insights and the information and some knowledge. We will now move on to the demo for the WebPro.
Okay, I will stop the share.
Okay. Thank you. Let me share my screen. Okay, hi everyone, Melvin from ShareInvestor. So I'll just do a quick run through on the our WebPro platform. We are a data platform and not a trading platform. So some of the tools that I'll just run through very briefly. So we do have prices. So we do have delayed prices and real-time prices. This is where you can view the stocks. So maybe if you don't want to look at warrants, you can filter it out here at stocks. Yeah, so this is today's real-time prices. More green today. So we do also have filters here like ranking. So we have the top active stocks, the top turnover, top gainers, and top losers for today. We also have information for over 5 trading days to 10 to 20, all the way up to 5 years. Yeah. So we have time and sales. So time and sales, basically we look at the intraday time of the day where people generally buy or sell. So maybe if you want to take a look at DBS today, recently DBS's prices have been dropping for the past few days. So for them, they have you can see that the trend now is more sell down than buy up. Yeah. So we do have a trade summary matrix. So you can see that there's more sell down and buy up also. These are the number of trades also at this price. Okay, we do have quote movements. So for quote movements, basically yeah, so the buy queue, sell queue, and then what's the type? Maybe it's a sell down, is it a buyout? Yeah. So we also do have a historical price. So for people who do a lot of research with the Excel sheet numbers and all that, right? Basically, they are able to download the historical price also. Yeah, so this is the historical price for DBS. So these are all the dates that's been trading, the high, the low, what's the closing price, and what's the percentage change, the volume traded, and yeah. So if you look at the fundamental tab, we do have a fact sheet. So basically our fact sheet is actually just a basic summary of the stock. So whether the company is doing well in the revenue area, it's actually been profitable the last 2-3 years. Yeah. So generally, if you were doing the fundamental analysis, you come and look at the financials tab here, where where we compile all the financial statements of the company. So let's say, for example, the default is up to 4 years. You can view up to 10 periods. Yeah. Hold on. Yeah. So it's the past 10 years data for DBS. So for the financial filter, you can choose whether you want to see the full year, whether you want to see it by quarter, half yearly, or either half of the year. Yeah. So this is the data. So this is how you can analyze the trend of the company, whether the company has been earning, how much is their financial cost. So you can also look at their basic earning per share, gross dividend. Yeah. So this is the balance sheet here over here. And we have the cash flow statement. So you can look at the company's cash flow. Is the company be cash flow healthy? Yeah. So whether they have enough free cash flow. Yeah. So if you want to see the period percentage growth, you can click on the plus tab here. So basically, you can see that year by year, you can see between 2019 it's a 40% increase from the previous year. It's another 111%. Yeah, so you can see the trend. So it's been. So over here, we have all the attachments of the financial results that's been announced on SGX for the company. Yeah. So we also have the financial ratio chart. So you can choose to see whether you want to see the trend for the past 10 years in line, like a line graph. Yeah, so you can look at the EPS, you can look at the price earnings to growth, uh, return on assets, ROE, ROA. Yeah. So if it's too cluttered, you can just untick them. Yeah. So this will be the values for the EPS, NAV. Yeah. So these are the compound financials. You can also look at the company's insider trades. So you can maybe see whether when's the latest buyback or sell by their management. So for example, Gupta, he sold his shares. He's been selling his shares quite recently. Yeah. So and so we can go to the events calendar. So we can have all the ex-dividend date, the quarter results, half-year results that's been announced for the company. Yeah, whether they have an AGM today at this timing. Yeah, then what's the dividend price, which record of payable date. Yeah. So that's it for events calendar. We also have dividend analysis. So you can look at the past dividend for the company. So you can look at the gross dividend per share, special dividend, or their total dividend per share also. Yeah. This is a tab where you analyze the dividend. Yeah, so this tab for annual reports, you can find all the annual reports for DBS over here. So you have all the reports starting all the way to 2005 all the way to 2022. Yeah. So we can also look at the charting because we use charting to pair with our fundamental analysis. So yeah, so maybe if you want to look at DBS, yeah. So this is the charting for the moving average for DBS. So recently, yeah, the price has been decreasing for DBS. For indicators, you can search for indicators here. So maybe you want RSI, you want, yeah, RSI will be shown at the bottom. Yeah. We can also look at the latest events on the chart. Yeah, so this is the news. So basically, yeah, so sometimes maybe the price will be affected by the news. And you are not want to see that all the news report here. So we have everything that you want to see over here that might affect the price. Yeah. So we also have corporate actions like ex-dividend on this day. Yeah, the announcement. Yeah, the quarter results. Yeah. So we also have a night tip over here. If it's too bright for you, or if you're doing your research at night, the night team will be better for your eyes. Yeah, so this is it for C2 chart. Yeah. Okay. So the markets that we have is we have Singapore, Malaysia, Hong Kong, Thailand, Indonesia, Australia, and US. So we only have delayed and real-time data for Singapore and Malaysia. Hong Kong is delayed. And then for the other markets, we only have the end of day data. Yeah. So maybe if you want to look at the New York US market. So we only have end of day data that will be updated around 10 a.m. every day. Yeah. Cost of subscription. So currently we have the Christmas promo. So you have about 15% off. So it's roughly around 300 per year. Yeah, so this is the available data that we have. Yeah, so we have a 9 days free trial for WebPro and 18 days for Station. Yeah, so if you want to, you can try it out. Yeah, so 15% off for Christmas promo will be around 200 plus. Okay, so we also have the compound news. So this is also accessible. All the news that for today from Business Times, SGX, Trading Central. Yeah. So we have the latest companies who have IPO'd. So Winking has IPO'd quite recently, last month. Yeah. Total volume of give me a moment. Okay, difference between the two plans. Okay, so for WebPro, everything is done on the website. So the price of WebPro is around 200 plus, currently 200 plus, whereas Station is around 800 plus. Yeah, Station is more for recommended for active traders. Yeah, it's more customized for them to view their chartings and stocks side by side. Yeah, so WebPro is generally more for retail investors or casual traders who only come in to take a look at the stocks and all that for time to time. Yeah. So forum for discussion on various shares. For forum for discussion, we do have it's actually InvestingNote. So if you're interested, maybe you can consider joining the InvestingNote community, where they yeah, so okay, never mind. So InvestingNote is where people discuss about all the latest trend and the latest shares. So you can take a look at the latest stock trends. So we do have a lot of traders, usually more local traders around in Singapore. So what they do is that they discuss about shares on this forum called InvestingNote. Yeah. So they will share about the latest news on the counters, like which counters has suddenly there's an uptrend in the price, maybe breakthrough. There's a breakthrough for it. Yeah, and then they're talking about usually they also do talk about Singapore REITs, what the latest REITs that's been trending, and yeah. Okay, WebPro is not a replacement for online stockbroker. It's more for a complement. So complement as in we make it more convenient for people to do their uh, more for their fundamental research. So for our platform, basically you have to you can create your own portfolio, which is pretty similar. You can create multiple portfolios, in fact, to do different monitoring. Yeah, and you also have to key in your own transactions, yeah, because we are not a trading platform. Yeah. So we help people to do compile all the financial data for the for our users to do more for their fundamental research. They are also able to do their own charting here. So it's not a replacement for the online brokerage. Yeah. Advantages of WebPro over TradingView. Okay, for WebPro, we are more for local market. TradingView is more for US markets or international markets, whereas our platform lean more towards the local market, like Singapore market and all that. So our features are also like pretty similar in that we both sides have charting, but what we have stronger than trading views, the fundamental side where we compile all the financial data for any of the companies that we have. Like maybe if you want to look at Genting, we have all the financial data over here. I don't think TradingView has a compiled list of such financial data for easier quick comparison. So yeah. Who owns ShareInvestor WebPro? It's owned by ShareInvestor. We used to be under SPH, but we were bought out by their management. Yeah. Hmm. Is there any other questions that you all would like to ask? Maybe to me or maybe to Hazel? Mm,
There's a question on by Ray, if Fed rate likely to stay higher to second half of 2024, but maybe a soft recession, does it mean now it is a good time to enter Singapore REITs whose fundamentals are good? Yeah, so the thing is we can't really predict as where exactly is the bottom of the crash for Singapore REITs. So what I do is when I see that the price, the REIT, okay, or the individual REITs where the share price has retraced to a strong support level, that is where I would then accumulate my share. But then I never like to buy in all at one shot. So what I usually do is I like to split up my capital so that I can actually buy in a few different tranches. Because the fact is that we cannot predict exactly which is that exact bottom, right? So what we can do is if the share price continues to retrace even lower after you buy in, you still have some bullets to actually lower down your average cost. All right, so this is to answer the question from Ray.
Okay. I think this will be all for today. Thank you guys for attending the webinar. I hope you guys learn new things or take away some insights from Hazel. What the hell? Yeah.
Thank you everyone for joining us.
Yeah. Thank you, Hazel, for sharing with us about the US market and about and the 3 learning points that at the end of the slides. Yeah.
I hope it has been useful for everyone.
Thank you.
Thank you, everyone.